to our ramblings.
Yes.
Everything sorted out. But hello, welcome everyone to the first ARP webinar of 2026. It's fabulous to have you all with us. Today's topic is a really important one. So TOMS, VAT reclaim, and how it impacts everyone in the temporary accommodation supply chain. It's something that I know has been coming up more and more across the industry, and I've personally had a lot of conversations about it. Because the reality is it's not just a finance topic, it could potentially be a business risk to everyone in that chain. So we are super pleased to have Laura Chip, the founder and director of VATNAV, joining us today. Laura is here to get us all up to speed on some do's and don'ts, and importantly, how to make sure that we're all being compliant and not facing any nasty surprises from the tax man. But before I hand over to Laura, just a quick note, Tad and I will be monitoring the chat throughout. So please do drop any questions in there as we go, and we'll pop them to Laura for you. Just a small disclaimer, both Tad and I are dyslexic, so if there's any mispronunciations, we apologise now, but we'll try our best. So without further ado, I'm going to hand over to Laura for her to introduce herself and get us all started.
Great, thank you very much, Joe. And hi, as Joe said, I am a director at VATNAV. I've been in VAT my whole career, but I've been looking at VAT in the, I suppose, travel, but that kind of comes over to things like tourist and visitor accommodation as well. And I've been doing that for about 15 years now. I really just want to speak today about the sort of broad overview of VAT for the sector for temporary accommodation. Now, before I start, I suppose probably a disclaimer in this is that in VAT, it's a sort of running joke that the answer is always, it depends. There are so many different things within VAT where very slight differences can make a massive difference to the VAT treatment. So I'm hoping that today you will get some information and some overview to help you to ask those questions for your own business. It may not be that you get a sort of 100% black and white answer in this next hour or so, but hopefully it will open the conversation at least. So on the agenda today, very loose agenda, but we'll go through a general overview of VAT in UK accommodation. We'll look at the difference between agent and principal and why that matters. We'll then look at the TOMS rules, which should, although they should not apply to this type of business, they often do. Then we'll look at how that changes when you act as agent. And also we'll go throughout the whole session, we'll look at how that may lead to risks and optimizations in your business and some possible future changes. So first section, very bright pink, I know, but this is an overview of VAT in the temporary accommodation sector. Now, I suppose the starting point for any VAT question, we always ask ourselves, firstly, what is the place of supply of something and what is the VAT treatment of something or the possible VAT treatments of something? Now, when we're looking at accommodation, any property supply, the general rule for VAT is that we're looking at the VAT rules or the place of supply in the country in which the property is located. Now, when we have any supply of property, it doesn't always matter, or doesn't normally matter where the supplier is actually based. It doesn't normally matter where the customer is based. The kind of trigger point for any property transactions and supplies are where is the property located. So if we have a UK property, we're normally then going to be looking at the UK rules. If we had a property located somewhere else, although the UK rules may be relevant in some circumstances, we'd normally then be looking at, okay, what does that country say is the rules for this property? So in the UK, where we've got UK accommodation, we're then looking at what do the UK rules say about VAT and property. And the starting point that we go on, surprisingly enough, given that most accommodation here will probably have some sort of VAT on it, but the starting point for any property in the UK is that it is exempt from VAT. We have a sort of big long list of, in our orange legislation book, of all the different types of accommodation that are exempt, and then a big long list then of exceptions to that exemption. So it's a bit roundabout, but basically, although the default is that property is exempt, there are a lot of exceptions to this exemption. And one relates to what we call accommodation for tourists or visitors. Now, where that's relevant here is that we're looking at what is a tourist, what is a visitor. And normally where we have that, we are looking at a taxable rate of VAT in some way. Normally that will be 20%, but we will talk about the other rules that apply today as well. So basically, we have in the accommodation sector, we've actually got quite a lot of options that could be applied for VAT purposes. So we have standard rated VAT, which is 20%. We also talk about what a lot of people will have heard about as being the 4% rate, but is actually a reduced value rule for long stay accommodation. We also have the possibility that it will be exempt. And we also have these special rules, which are TOMS. So there are lots of different potential possibilities for accommodation. I think the starting point for anyone, and potentially the easier question here, is the treatment between what is exempt and what is taxable. Now, if we were looking to consider whether temporary accommodation is exempt versus whether it's taxable, really the question to ask is, are we providing this accommodation for someone who is a tourist or visitor, or actually is the accommodation not that and instead is a residential type arrangement? Now, this is quite an odd question because in several countries, there is one sort of hard and fast rule about what type of accommodation is residential versus which is for sort of tourists and visitors. I think in some countries, just a standard sort of 6 or 8 weeks, and anything beyond that is then seen as residential accommodation, and anything shorter than that is seen as accommodation for visitors. In the UK, we don't have that. We have a lot of different court cases, which doesn't really make anything clearer. And it's basically looking at what is the intention, what are we actually doing, what is the purpose of that customer. But I suppose essentially the main differences that we'll see on a practical level between an exempt residential type accommodation and a visitor accommodation are what we see on the screen here. So if you're supplying a sort of exempt residential contract, we'll normally have a sort of type of AST style lease agreement in place with the guest. It will usually be the occupier's primary address. Property may be furnished or not. Normally, and again, I don't want to put a duration on here, but normally we're looking at accommodation that's 6 months or more, and the occupier may pay their own council tax and TV licence. Now, again, normally with this type of arrangement where we've got an exempt residential type thing, is there's elements that clearly show that even though it may be temporary and that someone may be waiting for, you know, a permanent house somewhere else, the temporary nature is not just a month. We're looking at a sort of longer term arrangement. Whereas if we're looking at a sort of tourist visitor type accommodation, it's a type of property that is normally held out and advertised for travellers and visitors. So for example, a serviced apartment, it may be some other sort of hotel style, apart hotel type accommodation. We would normally expect to see services that are usually provided within hotels. So for example, a weekly clean, towels, linen, etc. being provided. We wouldn't expect the occupier to be paying utilities, rates, etc. And it would normally be short term. But there is no hard and fast rule. I think with the temporary accommodation sector, we would probably start with the assumption that the accommodation is exactly that, temporary. So we wouldn't normally go into the types of business that you guys would be are into. We wouldn't normally expect you to be in the business of selling residential leases, but it may happen. It may be that you have, sorry, Dom, sorry, Tad, you wanted to say
I know,
something?
I know. Yeah, there's a chap who's put his hand up.
Mhm.
Um, James Connell. Could you possibly type your message in the chat box? Then we'll be able to answer it. Thank you. Sorry.
Okay. So I think we would start here that the accommodation is temporary and that the intention is not a sort of residential style contract. But we also need to consider the intention of the individual. So, for example, if someone comes to you and sort of says, well, I want this accommodation for a month or so, and then gets to the end of the month and they need it a bit extra, and that sort of actually continues for a while, even though the individual's never intending to settle in that apartment, and they may keep sort of adding on months or weeks regardless at the end. The intention there is probably never that that accommodation is their permanent residence. They're just it's a matter of circumstances as to why that's being extended. Whereas if someone came and said, well, actually, we would actually like this for a year, and we know that now we're going to take it for a year, we don't have an address anywhere else, we're not a contractor who's here on work, who has a home and a family elsewhere, but we're actually sort of going to settle here for a year, then that's more likely to be where we would consider an exemption. But there's no hard and fast rule. So I think where we have situations where it might be borderline residential and borderline visitor accommodation, that's where you potentially need to assess which is actually the better position. What can we argue? Can we do anything to tighten up the position we sort of want to gain from this? But in many cases, it may be completely clear. Because I think that brings us nicely into the other positive rate of VAT. I tell you what, to stop and Joe, you have a question to be answered on that.
Yeah, so actually it's a question from me. Based on what their reasons are, who dictates that? People can lie about why they're there. We saw it a lot through COVID on key workers and stuff like that. Like, who's the judge, jury, and executioner on that?
Yeah, it's a really good question. I think it's and there is no, again, it depends. But I think it literally, there is no one answer. So normally you would take the customer's word for it. A lot in VAT, we can't be expected to go and like interrogate every customer, and HMRC don't expect that. So it may be that if you have contracts which are kind of borderline, it may be that it's part of the initial take on questioning to the customer to say, what is your intention, or how long are you expecting to be here? When are you expecting to move into a permanent residence, or something along those lines? So you have some sort of way of putting a question within the initial take on questionnaire or document or whatever it may be. And then if HMRC do say, well, why have you decided that this is for a visitor versus residential, then you can point to something and sort of say, well, because we ask our customers to self-certify this, and they've done so. But yeah, I don't think HMRC expect anyone to kind of interrogate or surprise visits and sort of check whether they've brought in extra furniture and stuff like that. I think it's actually an important point. A lot of people think that HMRC kind of almost come in almost a bit like the police and sort of say, right, you're doing that, you're not doing that. Actually, HMRC are normally quite human about things, and they expect that as long as people have got a reasonable process in place, it's not going to be, they're not going to penalise you if one customer has lied or potentially been misleading on their on whatever way you've chosen to ask the question.
Yeah, perfect. Thank you.
And Tad, sorry, you had something else?
There's another question. What if a service department is booked for a project for an assignee for, say, 6 months or longer, and will be their permanent residence during the course of their stay?
Well, yeah, that is probably, I would say, a borderline situation. If it's a project and the situation is going to go for 6 months only, then I suppose yes, it's borderline. I would say you would consider there what would be the alternative for him. Would he normally have booked himself into a kind of any serviced accommodation that's normally held out for visitors. Say, for example, on Airbnb, you can book stuff for, a number of months. If something is kind of held out for advertising in the same way it would be for any other visitor, then you're probably looking more along the lines of a visitor accommodation. Whereas if we're looking at advertising something here as temporary accommodation. If someone came and specifically said, can I use this as my permanent residence for 6 months? And then I think we're looking at, okay, could it be residential? In which case, how do we cement that? If we want it to be residential, we want it to be seen as a residential lease, then we will be looking at cementing that in as a residential lease and sort of having an appropriate contract to say that. But I think that type of example is something that kind of could go either way. But it will depend on factors. So contracts are important. What is your agreement with the customer? If you want it to be residential, then I think in that situation, the contract will help confirm that. If you want it to not be residential, then I think, again, we need to move away from the sort of lease style contracts and into looking at, okay, let's give you this on a nightly basis, however it may be invoiced per month. You don't have the same rights as someone would do had they been the tenant, etc. So I think it's not a hard and fast rule, but I think there are ways you can sort of cement the position here. I think there's a couple of court cases relating to student accommodation on this. So obviously the student has an address elsewhere, being their parents' address, and they live elsewhere, but they often settle in a particular university town. They know they're going to be there for 10 months of the year. They may have their doctor's surgery there. They may pay, obviously like rates and TV licenses. I used to have to pay a TV license. So it's kind of it's a borderline case. In most cases, the courts have said that university students, that is a residence rather than they're not visitors. Whereas I think there are other cases that say if you have a sort of short 15-week course, so it's a sort of, I suppose, one-term course, that's more likely to be a visitor. So it's kind of, again, it's really difficult because you kind of do what you want with it almost. But I think the important thing is that there has to be something to back up the treatment there. Okay, so in terms of this reduced rate rule, so I think a lot of people call this the 4% rule. It's not a 4% VAT rate. It's actually a way of basically, it's a VAT relief on the accommodation aspect of a stay for visitors after 28 days. So here we're on the basis that we're looking at visitor accommodation, which would normally be 20%. But now the room or property has been occupied by the same person for more than 28 days. The relief applies from the 29th day onwards. And what it is, it's a relief, it's not an exemption, it's not a reduced VAT rate. It is a relief which we relieve VAT on part of the value. And basically here, after the 28th day, the accommodation element becomes non-VATable. So not exempt, just kind of almost ignored for VAT purposes entirely. It just becomes nothing really. And basically HMRC say here that at least 20% of the value must remain VATable as facilities, so additional services, to account for other services such as cleaning, linen changes, media entertainment, etc. Obviously sometimes catering, not normally in these circumstances, but where it applies for hotel long stay guests it may do. And basically what they say is that 80% of the value must be non-VATable. You have to keep 20% as a VATable amount, at least. So 20%, the 20% amount is still taxable at 20%. So 20% of 20% equals 4%. So normally that's why we call it this 4% rate. It's because it's 20% of 20% value. Obviously, if you're providing facilities which you think account for more than 20% of the value, then you would have to revise that rate. So let's say you're at a hotel where there's spa facilities, gym facilities, obviously breakfast involved in that. It may be that actually, more of that value is for the additional services, not just 20%, in which case it wouldn't be a 4% rate, it might be 20% of 30%. But in these circumstances where we're looking normally at accommodation, such as serviced accommodation in apartments, we would normally be saying that 20% of 20% is comfortably met. So basically, here is an example of how it would work. If we have £100 for a room, we're basically saying that 80% deemed to be for accommodation, which is non-VATable after 28 days, 20% deemed to be other services, which is still VATable after 28 days. So therefore, we're paying VAT at 20% on 20%. Yes, Joe.
Unmute myself. So James has asked, what if the additional services are charged separately from the accommodation in terms of the previous slide?
Doesn't make a difference for HMRC. If you have one amount for accommodation, you single out what amount is for additional services, then if that amount is more than 20%, then you'd be paying VAT at 20% of that higher amount. If that amount is less than 20% of the full service, you'd still have to pay 20% on the full, you still have to pay VAT on 20% of the overall service. So yeah, I think the point about sectioning things off is a good one. In some cases, for VAT purposes, that is a good position, but for things like this, where basically we're looking at those services really being an ancillary part of the accommodation, that's still deemed to be one service. And then we're looking at 20% of that overall amount. So you may invoice it separately. So let's say in this example, you invoice £80 as accommodation and £20 as other services. You'd still be in a situation where the whole amount would be deemed to be 100 because that's the other services are ancillary, and therefore we're still looking at 20% of 100. A note on the actual VAT position for these services. If we look at the box at the below on the screen, it's an important point that if, let's say, we quote £100 a night plus VAT for something, then in week 1 we've got £700 plus 20% VAT, same as week 2, 3, and 4. And then in week 5, we can only charge 4% VAT, let's say 20% on 20%, which gives us £28 of VAT. So in week 5, we're charging the client 728 as opposed to 840. Now, if we were doing £100 a night inclusive of VAT, this situation changes, because in this case, we're still doing, we're charging £700 every single week. However, whereas in the first 4 weeks, you are then giving HMRC £116, in week 5, you're only giving HMRC £26.90. So in that situation, it's really important to differentiate here whether or not the amount is inclusive or exclusive of that. This is for many reasons, not just this 4% rate, but it really changes the result depending on whether you've quoted your original price inclusive or exclusive of VAT. So limitations to the reduced value rule. I think this is important because I think in the industry as a whole, we hear a lot of people just say, oh yeah, it's, we can just charge 4% after 28 nights. It's actually quite a strict process with HMRC. It's not just a case of any accommodation can be 4% after 28 nights. So firstly, it does apply on a wholesale basis. So let's say you sold to a corporate customer and then they made a recharge onwards to their employee, or you made the charge to a corporate group headquarters and they recharged it onto each individual company within the group. You are then making a wholesale supply. You can still use the 4% in that case. You don't have to be selling to the final user of the service. But it doesn't apply where the same company uses the accommodation for different individuals. So if, for example, we have one company booking for 6 months, but it's a different person every month who occupies the accommodation, that's not the reduced rate because it's not the same guest. It has to be the exact same guest who's in there or the same lead guest. Sometimes we see these situations with contractors, and we get asked the question, well, how do we know who it is? It's always the same lead person booking. And the answer there is you sort of have to rely on what the customer says, but the onus there is on you to confirm that in writing with the customer. When you say, who is the lead guest? Will this lead guest be changing at any point? If they answer no, and you've got no reason to believe that they're being misleading, then that can be taken as sort of okay. But HMRC are quite strict on this. So if there is possibility that the individual may change, then you need to be looking at this in more detail. It also doesn't apply where the stay is non-continuous. So if, for example, someone books the accommodation from Monday to Friday every week, but doesn't book the weekends, that isn't the reduced value. That it just isn't a continuous stay. Obviously, if someone books the accommodation but occasionally leaves for the weekend or occasionally leaves for a week away on their holidays, that's fine. But the intention has to be that, you know, the person is there continuously. They don't keep leaving and coming back. And, you know, it also doesn't apply to what we call holiday accommodation. And this is something I don't actually like in the VAT guidance, because they describe holiday accommodation in very similar terms to how they describe serviced accommodation. And it's accommodation for someone on their holidays. Now, I think the point about holiday accommodation is I would hope in most circumstances this won't apply here. Because when we're looking at holiday accommodation, we're looking at things that are clearly advertised for holiday customers. So the guidance talks a lot about things like chalets and caravans and lodges and things like this, which are kind of on holiday parks or within some sort of resort designed for a holiday. Now, it doesn't exclude houses and villas and stuff. Obviously, in many cases, the same apartments that you guys may use for temporary accommodation may be used for someone on their holiday. But I think the point with holiday accommodation, from my reading, is that it's very much trying to be fairly an entertainment type place. It's somewhere that's sort of very popular on holidays for exactly that reason, and unlikely to be seen as a sort of temporary residence in that way. But really, there are still limitations to this reduced value rule. So we see a lot of businesses just get given invoices from their supplier, which has this 4% rate. And they think, all right, okay, well, I'm just going to invoice at 4% for the same thing. It's still the onus is on you to make sure that 4% definitely applies in these circumstances. Obviously, your supplier needs to check for their own purposes too, but that's maybe not your issue. Okay, so then in terms of principal versus agent, now obviously we've talked about what the rules are for actual what happens if you're supplying property. But I suppose this question is, are you actually supplying the property at all? If you're not the owner of a property, we must actually ask whether you're acting as principal or instead you're acting as agent. If you're acting as principal, you are then buying and selling the property. If you're acting as agent, you're really sort of passing through the cost and arranging it on behalf of someone else. Normally, this is going to be determined by the contracts, but it's backed up quite, you know, it should be backed up at least by the invoicing position and other sort of practical factors like communication, risk, etc. In practice, though, the difference can be quite subtle. So here we've got a case where we're acting as principal. The pink lines there show the money transactions, and the blue lines show the contractual position. So here the customer pays 130 to the RMC, and the RMC then pays 100 to the supplier, keeping 30 as its margin. The supplier sort of supplies serviced accommodation, and the RMC supplies it along. Now, as agent, the exact same monetary transactions happen. The 130 is still given by the person to the RMC, and the 100 is still given by the RMC to the supplier. But here, actually, what's happening contractually is the supplier is saying, right, well, we're going to supply the accommodation directly to the customer for 130, but we're going to give the RMC 30 for its agency fee, so we only receive 100. So it may look very similar. You know, you still may have a customer pay 130 direct to the RMC, but we don't actually know who has agreed to supply the accommodation to who until we look at the contracts. Now, I appreciate this is quite a busy screen, And really, I've put this there, so hopefully you can look at it on the recording in your own time. But on the left-hand side of the screen, this is how we would expect the contracts to look if we were acting as a principal. So with our supplier of the accommodation, we will usually have a contract for the supply of accommodation. May include some property responsibility. So you as the RMC may agree to keep the property clean and tidy and pay for any damages, but not usually direct. It wouldn't be a direct agreement between the supplier and guest. You'd usually also have a fixed nightly rate, so a net rate agreed with the supplier. And the supplier is unlikely to have much input in then the onwards agreement between you and the guest. When you have your contract with your guest as principal, again, you should be named as the supplier. You should be able to set your own selling price and mark up that net rate. And you may impose obligations yourself on the guest, such as cancellation terms, damage terms, compensation, etc. So you would be directly liable to the guest, not the supplier. And there should be no direct contractual relationship between the guest and the supplier. Now, on the right-hand side, what would it look like as agent? So firstly, I think HMRC are less willing to entertain agency than principal. So we have to really prove if we're going to be an agent. So it should very, very clearly state in both contracts with the supplier and with the guest, that you, the RMC, is the agent. You would normally then say you are acting as agent for whoever. It could be the supplier, it could be for the customer, it could be both. But you would then detail your payment terms, normally being a fee or commission in return for your agency service. Normally a percentage, it can be a fixed rate, doesn't really matter as long as it is a clear commission or fee for that agency service. You shouldn't yourself be mentioning that you are the supplier or that you are supplying property onwards, and you shouldn't have responsibilities relating to the property. Your responsibility should be the booking service. So when we talk about in a contract, the RMC will be supplying services. The services in question would normally be the booking, the managing, the facilitating, not the supplying of accommodation. That's it. Yeah. Okay, that's it for that section. So I think really, I think for agency services, in many cases, it will be more efficient for the RMC to act as agent. But I think the important point on this is that regardless of who says they're doing what in practice, how payments are being made, the contracts are really important. And people get fed up of me saying, what does the contract say? What does the contract say? All the time. But really, that is the fundamental point here. And it's especially important with proving your status as either agent or principal, depending on what you want to be, because this is where HMRC look as a first port of call. Yes, Joe.
Sorry, it's actually another question from me on this. So in the scenario, if the contracts state that the RMC is acting as an agent, but then it goes through a service department agent before it then gets to property, what does that then look like? So if there's markup at 2 stages.
That's fine. You can have two agents. You could have the other agent being the agent of the supplier and you're the agent of the customer, or you could be a sub-agent of that first agent or vice versa. You can have two agents in the chain, and I'd probably suggest that's the most efficient way of any chain being made, such that especially for corporate business, that the initial supplier is contractually supplying directly to the end customer via various other people acting as agents. That is normally the most efficient structure for corporate transactions. But yes, it must be clear in the contract. So sometimes we have someone saying they're acting as an agent of the customer, but then they've signed a contract with the supplier saying that they're buying the accommodation in. That doesn't work, because now no one is actually supplying the accommodation to the customer. You have it in the business as as where you've got it, and then you're acting as agent for the customer, so you're not actually supplying anything to them. So the customer's never received the accommodation supply. So I think Where we have lots of people in the chain, I think the important thing is that the transactions have to match, and we have to be clear that our contracts make sure we know what we are, and that the anyone else in the chain, their contracts don't contradict that. So yeah, I think contractually anything can normally be made to work as long as all parties are aligned.
Perfect. And we've got another question from Duncan on the chat. So company leased housing, so residential HMO properties, the company head lease pays rent, utilities, etc. The occupier employee subleases will rotate in and out. The company has occupancy agreements with the occupier, including a housing deduction from payroll. Should these deductions between employer/employee be VATable?
Oh, a difficult one, because it depends on it depends if it's a benefit. I mean, I think if it's something being deducted from payroll, that normally suggests that there is some sort of onward supply there, but really difficult to know the answer to that without seeing all the contracts. Again, depends on the contracts. But yeah, I think that's probably something that needs to be looked into as to whether there is some sort of onward supply, and if so, what it is, and also whether it's a whole supply or it's just a cost contribution. So I think the answer is potentially, but I can't confirm just from that whether or not that would be the case. But yeah, I definitely think that's something that should be looked at if there is some sort of deduction being made. Okay, so TOMS. So yeah, this is a really odd one, but I think it's really, really important for this sector. So TOMS is the tour operators margin scheme. Really, it's for tour operators, but basically it's HMRC apply TOMS quite strictly. So if it applies in a circumstance, it just applies. You can't just get out of it. So in order for TOMS to apply, you have to supply travel services in your own name and acquire the services from a third party without material alteration. It's compulsory where you're selling to the end customer, but optional for wholesale supplies. The reason these can apply for temporary accommodation is if we take away the fact that some may be residential and assume that what we've got is serviced accommodation supplied for a tourist or visitor in this case, we've kind of got that here because we've got accommodation which is being bought in and sold on. Material alteration, we'll talk about this, as I mentioned, the Sonder case briefly. But where you're sort of just buying in a week's worth of accommodation from a supplier in your own name means as principal. So we just talked about that in the last section. If you're buying in visitor accommodation as principal for a week and selling on for a week without yourself actually owning the property or furnishing it or doing anything to it, you would normally meet the criteria for TOMS. So if you are in that sort of bracket, TOMS may absolutely apply. It does to many RMCs, not all, but where you're acting as principal is definitely a consideration. Now, what happens in TOMS? Basically, instead of being able to issue a VAT invoice for 20% or 4% to your corporate customer for them to recover the VAT, none of that happens here. In TOMS, what we have is standard rated VAT is due regardless of the length of time. Standard rated VAT is due on the direct to UK margin only rather than the full selling price. No input VAT can be recovered on direct costs. And more importantly, no VAT invoice can be issued to your customer, so your customer cannot recover VAT. So basically, if we have I've already got an example, let's do that, that'd be easier to look at. So if you have accommodation, let's say you sell it to a corporate client for 1,500 and you purchase it from the supplier for 1,000 plus VAT at 20%. So your purchase price is 1,200. Under normal VAT rules, and what many are doing in this situation, regardless of whether that may be correct or not, is you've got the supplier, so you, the RMC, have an invoice for 1,000 plus VAT, so you'll probably recover £200 of input VAT on that purchase and charge £250 on the sale. Being there that the 1,500 is the gross amount, so the 250 is the VAT on your sale to the customer. So the corporate customer can recover that 250. So what happens with that is that your position as a supplier is that overall you've got a £50 payment to HMRC, being the 250 you've paid as output VAT, less the 200 you've recovered as input VAT. The customer's position is that they can recover VAT of 250, meaning the net cost to them is 1250. Under TOMS, your position doesn't really change in this circumstance, ignoring any long stay accommodation. But under TOMS, you can't recover any of the VAT on your purchase, so you can't recover that £200, and you will pay VAT on your margin instead of the full selling price. So the margin you're making here is 1,500 less 1,200 equals 300, and you're paying VAT out of that margin of £50. So the supplier's VAT position looks exactly the same. But crucially, the customer's position means they can't recover the VAT. So now the net cost to them is 1,500. So this, I think, is the important thing with TOMS when we're looking at supplies to corporate customers, is that through no fault of anyone's own, there's no reason why anyone should have been looking at tour operators and considering themselves a tour operator. But the point here is that where TOMS does apply, it applies quite strictly. So if anyone does buy and sell visitor accommodation in their own name, doesn't do anything to that apartment and sells on the same duration as they've bought in, it will often be covered under the TOMS rules, which means that although your own VAT position may look the same as under normal rules, other than supplies of long stays, your customer's VAT position will look very different. And that's potentially the risk here with TOMS. Now, I'm not going to go into the TOMS calculation today, but I think just an awareness point on this, that TOMS is carried out once a year normally following the financial year end. We're not normally looking to calculate, as in the previous example, as VAT on every single individual item. But what we normally do is throughout the year, we sort of estimate the VAT payable based on previous years. And then at year end, we think, okay, what do we actually do? What's our actual margin for the year? What should we have paid? And then we sort of do a true up and adjustment at year end. Now, without wanting to scare anyone about the format of the TOMS calculation, it can actually be quite straightforward for suppliers of accommodation. I wouldn't be particularly worried about the calculation itself. But I think the important thing about this is that your TOMS supplies and costs should really be kept under separate coding, separate, very, very different from any other types of services that you do in your business. Because at year end, that'll make it a lot easier to do the calculation itself. Now, is TOMS always bad news? We've talked about the risk of TOMS. And yes, I think in many ways, it is not good news for any sales to corporates. In fact, so much so that HMRC are looking at a UK TOMS reform at the moment. And one thing we've specifically mentioned to them when we did a consultation with them for their information gathering is exactly this. We said, look, we understand the point of TOMS, really, without going into too much detail, was that when we were members of the EU, tour operators would otherwise have had to register in every single EU member state to pay VAT over there. TOMS, instead of that, we're saying, okay, we don't have to go and pay all the output VAT everywhere and recover input VAT from 28 different authorities. We pay VAT on the margin in our own country. So that was kind of why it was happening. It's a simplification. The point was never about trying to restrict input VAT for corporate businesses. So one thing we've sort of said is, look, there's no reason for you to need to restrict input VAT for corporate businesses anymore. HMRC know that that was never the point of the scheme, and they know that restricting the input VAT is an unnecessary consequence of this scheme. At the moment, the rules exist that sort of has to happen, but that isn't going to be, isn't the point of the scheme. So we're hoping that may stop at some point, but at the moment, of course, that isn't the case. So yeah, TOMS is typically not advantageous when sales are made to corporate customers who can otherwise recover the VAT, or where there's a long stay element. One thing we haven't actually tested with HMRC is the effect of the long stay element, but we have to, at the moment, assume prudence that the long stay element, the sort of reduced value rule, we have to assume that can't come into it at the moment. We are going to test that though, actually, which will be interesting. If the customer cannot usually recover the VAT, the position may be neutral, because if we go back to this previous slide, under normal rules, in this example, if the customer can't recover that VAT of 250, then their net cost is going to be 1,500 anyway. So we don't really care. I say we don't care, but there's no particular VAT difference between the two items. The only time it may be advantageous is if the supplier has not charged VAT and the customer cannot usually recover VAT. So let's say that you have no input VAT to recover from your supplier for whatever reason. Maybe they're not VAT registered, maybe they're, whatever their situation is, and the customer cannot usually recover VAT. Then basically what we're saying is that there's no input VAT difference there between the normal rules and TOMS. But instead of you having to suck up the cost of VAT and the full selling price, you only have to suck up the VAT cost on the margin. So TOMS can be good news in those circumstances. And this actually is what the Sonder case is all about, which I'll talk about after this screen. If you think you may be within TOMS, because I think I do appreciate that some people here may never have heard of TOMS or may not have considered it, I think the first thing to do is review your services and contracts. It's always important to think, are you actually the supplier? Are you actually acting in your own name? And are you selling to end customers for their own use without material alteration? If you are within TOMS, then I think the next thing is it actually good or bad? What is the situation for your business? It will differ for everyone, I'm sure. If you do fall within TOMS and you don't think you want to, then I think then we consider, right, how do we get out of it? So the obvious answer there is, can we act as agent? If we act as agent, we're not going to fall within TOMS because we don't meet that first criteria. We're not supplying property. The other thing is, can we act as on a wholesale basis? So sometimes the other reason that TOMS sometimes doesn't matter is, let's say we sold on a wholesale basis to someone who's based outside the UK and they're going to sell on. In that case, we may use TOMS. It may be kind of fairly neutral because they're not going to recover the VAT, but their onward supply may fall within TOMS. But if they're based outside the UK, they're unlikely to have any UK VAT liability. So in some cases, acting as a wholesale supplier can also alleviate any unnecessary VAT cost. The other point I do have to mention, which is not going to be liked by anyone, is that if you do think you're in TOMS and you haven't been doing it, then I would advise the backdated position is considered, because obviously this then potentially is a VAT error, and you may have either a disclosure issue to HMRC or a disclosure issue to customers if invoices have been issued unnecessarily. So I think all of those things, if what you've heard today about TOMS has been surprising, then I think I would suggest all of these at that point. Now, Sonder itself, because I think Sonder has been mentioned a lot in the industry, and in Sonder's case, TOMS was one of these scenarios where TOMS was a good thing. This is because Sonder supplied short-term accommodation to travellers. It bought in long-term fixed leases for 2 to 10 years and added its own utilities, services, furniture sometimes, etc. So what it was buying in was an exempt lease. There was no VAT to recover on those exempt leases. But what they were selling on was accommodation to travellers who, again, normally could not recover the VAT. So they had no VAT to recover. And they were, in normal rules, having to then pay VAT on the full selling price. Now, if Sonder was in TOMS, it would still have no VAT to recover because there isn't any and it's blocked now, but it would only have to account for VAT on the margin. Now, it went to the first tier tribunal and they said, yeah, absolutely, you can be within TOMS, because even though it has changed the lease duration, added bills, repairs and maintenance, etc., the judge said that in order to actually materially alter the services to fall outside of TOMS, you would have to actually fundamentally change the capital nature of the apartments, knocking down walls and doing something that can't just be undone easily. But where we are now with the upper tier tribunal is that they've said, well, actually, no, we think that the fundamental difference and the actual material alteration that's applied is between buying in a 2 to 10 year lease with a bundle of rights associated with a sort of residential accommodation and then selling on as a taxable license to occupy for a 1 week stay or whatever it may be to a guest. So they've said that there is a material alteration between what Sonder bought in and sold on. Now, we don't necessarily agree with all the points raised, and we don't necessarily agree with the way they were raised. But the point is that at the moment, Sonder lost its upper tier tribunal with a judge saying it's not in TOMS in those circumstances. The case has been sought to appeal at Court of Appeal. Obviously, in the meantime, Sonder went bankrupt. So what we're doing is we're trying to work with the administrators and the advisors to try and find a way for the case to still go ahead. We don't know how that will look at the moment, but we're hoping that it will still go ahead. They've currently had a stay to appeal. We're hoping that it may go ahead later in this year because we do want to have a final answer on this point. But the point here is that this relates to a situation where we've got an incoming lease of some description, normally for a term of years. We're not talking about cases where you've bought in a week and sold on. So I don't think we can normally use Sonder to say all supplies of this type of accommodation fall outside of TOMS. They don't. I know that it's good news for some if they can fall outside of TOMS, but the Sonder scenario is very different from the purchasing accommodation for a week or a month and selling on for a week or a month in the same way. The VAT, I know I'm conscious of time, the VAT position for agents is very different from if you were a principal. So very, very quickly, an agent supply is your commission only, your fee only, so your agency service. The consideration is not normally where the property is, it's firstly who is your customer. And that person is going to be who is actually paying you the commission, who is legally liable to pay it to you. If that is a corporate business, so the landlord or a corporate customer, your place of supply of your fee is where that customer is based. If it's an individual, the place of supply will be normally where the properties takes place. But let's say we have a corporate customer or a landlord paying you the fee who's based in the UK. What's actually the treatment? Normally, if it's a UK-based supply, your agency fee is going to be standard rated. But if your customer is a corporate customer or a landlord based overseas, your commission will usually be outside the scope. Now, if instead of being a booking agent, you're a full managing agent, you actually go and do loads in the property, similar to that of a sort of estate agent, full sort of managing services, that may change because in those circumstances, your services may be seen to be more kind of physically attached to the property rather than something that can be done remotely. But if you're not yourself on the ground doing things in the property, then we'd normally say you were a booking agent alone, and your fee will be based on where the customer is located if they are a corporate business. So some possible future changes to be aware of, and this is the last slide, which we're kind of just about on time. So obviously what's going to happen is there will be an outcome of the Sonder case. Whether or not that changes anything for you individually, what we're expecting is that whatever happens, this will change TOMS itself. HMRC are likely to be looking to reform TOMS, and we think they're probably waiting for Sonder before changing it. And also another case in Bolt, the taxi case. For businesses who are agents, there are some upcoming changes in the EU called the VIDA rules, which puts obligations on the agents to account for VAT on principal's behalf and or collect principal VAT numbers. We're expecting at some point those changes will be introduced in the UK. And we're also expecting HMRC to be a lot stricter on the long stay rules. So there are changes coming up in the sector for VAT. None of this stuff moves particularly quickly, but it is something to be aware about for the future. Although property and VAT can be sometimes a little bit staid and a bit kind of, tired, there are changes coming up, and these areas do need to be, you do need to keep tabs on these where they apply to your business. That's really all I've got to say. I've got 4 minutes, I think, before we have to give the Zoom back. So yeah, Joe and Tad, over to you.
Oh, perfect. Thanks very much, Laura. Lots to take on board. It's not an easy subject, but you've explained it really, really well. So thank you very much for that. There's no questions in the chat at the moment. I do have a couple from my side as well in there. So my understanding is if you fall within TOMS and you are, say, again, using RMC as agent, service department agent as agent, supplier as, property provider, if the RMC is adding a markup on after they receive a net rate from the service department agent in the UK, can they roll that up into the net rate, their markup into the net rate, and still have it broken out?
Yeah, so I think so again, it's going to be contract dependent, because when we talk about a markup as agent, we're normally talking about some form of variable commission. So it may be that whoever is paying you the commission, if it's the supplier or the agent on behalf of the supplier, they may sort of say something along the lines of, we expect, the gross selling price to be, set by you based on, the fact that we receive £1,000 net, and you're able to add a variable commission to, as you think. It has to be worded, that's not very well worded, by the way, but it has to be worded well in the contract, because we don't want to talk about marking up net rates if we're acting as agent, because that signifies that we're a principal. So everyone has to be under agreement that it's going to be looked at as a variable commission that the agent is allowed to add for their own. That has to kind of go down the chain as well. But yeah, so I think adding some sort of extra amount doesn't preclude you from acting as agent. I think in those situations, the overall contract should be crystal clear in all other senses that you are an agent. And the point about the commission and the flexible amounts needs to also be really clear. But yes, I don't think that's not necessarily a no, but it's not as easy to kind of evidence.
I think they're about to be cut off.
All right. So
thank you very
for
much,
having
Laura.
me.
No, pleasure. We'll work
thanks
out about the recording once it's all over and done with.
Yeah, and we'll send everything out for everyone that's joined. So thank you very much for joining today, everyone.
Yes.
We'll follow up. And then if anyone has any questions, wants to know more information, please do reach out to Laura. We will pop her details in the thank you email along with the link. So if you want to carry on the convo, I'm sure she'd be glad to help.
Thank you very much. Thanks for listening.
Amazing. Thanks all. Have a good day.
Cheers. Thank you.
Bye.